Well, it could turn out to be a long winter for cryptocurrencies. Yes, Bitcoin and other cryptos have been backed out of shape, with Bitcoin plunging below the $30,000 mark. And this after it had hit a lifetime high of $69,000 just 6 months ago in the month of November. We have seen the US inflation hovering around that 8.5% mark, which is at a multi decade high, and the Fed has embarked on a rate tightening cycle with a hike of 50 basis points in the last meeting. So all in all, the Fed is expected to hike interest rates until and unless inflation comes back under to its comfort zone of 2% or thereabouts. So the fact that cryptocurrencies have been moving in tandem with the S&P 500 or the equity markets establishes its correlation with equities and has quash the myth that cryptocurrencies are a hedge against inflation. But many believe that this could be a golden opportunity to enter into the cryptocurrency space when it has its fair share of risks. If you have somewhere around 1 to 2% exposure to cryptocurrencies in your portfolio, it's still fine because investors will have the stomach or will have the ability to stomach that kind of a risk with respect to the volatility that comes along with cryptocurrencies. But if you have 20 to 50% exposure to this asset class, then it will throw your portfolio into a state of disarray. So you will have to calculate your risks if you choose to enter the space at the current juncture. It's extremely crucial to set goals with respect to its performance in your portfolio so that you can exit at the right time and limit your losses when it comes to this asset class. In fact, given the fact that there is no regulatory body to govern this asset class, many believe that this asset class would be able to weather any kind of international war or slowdown, but that was not to be. When it comes to crypto investments in India, there are other issues at play. Remember, there has been a drop in crypto volumes on crypto transactions after the government announced a 30% tax rate on income arising out of virtual digital assets. Not just that, another 1% TDS was announced on the gains arising out of virtual digital assets. The industry has been in up arms ever since. It has been urging the government to reduce TDS because it will hurt the retail investors. In fact, there are now reports emerging that the government is also mulling imposing a 28% GST on crypto transactions. Remember, GST is not levied on income arising out of virtual digital assets, but it will be levied on the total transaction value, and this will be passed on to the investors. The government is yet to outline a regulatory framework to govern this asset class, and due to a lack of clarity, a lot of these financial institutions like Kotak, which had earlier welcomed crypto, have stopped accepting payments for crypto intermediaries like CoinSwitch Kuber. In fact, Coinbase has also halted accepting payments via UPI, with the CEO citing informal pressure from the RBI. So even though investors may be tempted to take advantage of this crash that we have witnessed in the cryptocurrency basket and buy these digital assets at lower levels, its highly volatile nature, the high rate of taxation, as well as lack of regulatory framework may just compel them to stay away.